We are back. Tony?
Yes, sir. I am here.
I'm Tom Sosnoff. He's Tony Battista. You're listening to Get Tasted in the House. Nick Fenton.
Hey, what's up?
That's the best rapper intro you got?
Yeah, that's right. You do a little bit
Yo,
of
what's
rapping,
happening?
right?
It's Don for Tony, your number one homie.
Much better.
Much better. Much better. Now we can start selling your CDs again.
Yes.
TickerTank.com.
TickerTank. TickerTank. Ticker plant.
I knew that was coming.
I remember when you first joined our superstore.
TickerTank. Ticker plant.
Yeah, I remember very well. Ticker plant, I think you called it.
Well, you mentioned your company for 4 days afterwards just
Taint.
to make up for it. So
That's beautiful.
Tank, whatever it is.
Yes.
So, Nick, what brings you to Chicago?
Well, actually, of course, I wanted to see you guys. I haven't seen you in a while.
Of course.
Yeah. Q invited me to the Wednesday chat at Thinkorswim.
Oh,
So I'm going
nice.
to be a guest on that.
And you got the memo about the blue shirt that we were going
I
to
did,
wear today.
yeah.
Perfect.
Go
perfect.
Cats. We're all celebrating the national championship. Us three. I know you guys are Cats fans, right?
My son goes to Kansas. I can't help you
Oh,
there.
really?
Yeah. So.
Yeah, we're huge Cats fans.
I know. No, it was a great game, though. It was really fun to watch.
Great game if you're a Kentucky fan.
It was a great game if you're a Kentucky fan, and then the Final Four Kentucky-Louisville matchup was just insane.
You guys wanted to bring
Where'd
out
you
the
go to
guns
school?
down there.
I went to UK.
Oh, you went to UK?
Yeah.
Oh, so
Yeah.
okay. That's a tough call then, yeah. So, how many kids go to that school?
35,000.
Oh, okay. Yeah. I've never been there. I've been to Louisville, but I've never been to Kentucky.
Lexington.
I know. Anyway, man, so good to have you here in the studio, and it's fun. And we're about to head into earnings season.
Sure.
I feel like we never ended earnings season. I feel like
it seems like it comes every quarter.
That's the weirdest thing. Why does it come every quarter?
What's up with that?
Taxes come every year, full moons once a month. What's going on?
Right.
But it kind of feels like this one was just a long, went the whole couple of months. But Nick, one of the nice things, in the past as a trader, I don't really think I cared about earnings so much because earnings were just a blip. They were pain to deal with because I was like an index trader. I don't really.
You'd go in and try to just do a quick earning play, and some place was paying a high dividend. Try to skate on some.
It was just
Yeah.
earnings
It was
plays.
ridiculous.
Earnings plays were here. They were never viable because it didn't matter because number one, there wasn't enough short-term liquidity or short-term activity, and there weren't weekly options. So just the fact that a company has earnings in the beginning of the month, there was no way to play it.
Right.
Unless you're playing it pure directional.
Mm-hmm.
There was no real premium play in there, and also I got to tell you the weird thing: nobody would trade with you. Like
Sure, yeah.
It's like poker players playing poker
Because
players.
you walk into the pit and you go, "What's the market?" And they go 5 to 5.5, and you go, "Okay, so I'll buy some at 5:30."
They'd be
We're
like,
5:30 bid with you at 6. Why don't you get out of here, kid?
Why don't you go F yourself? Would be the answer. My market
I stand here all day and make markets. Now, you think you're going to come in here and just start trading?
My market is no bid, go screw yourself. Okay, that would be, okay, great.
Luckily, the game has changed.
Luckily the game has changed. And you have,
significantly.
yes. And that's the wonderful thing because now it doesn't matter who you are. Everybody's the same. And it should have been like that all the time.
Of course.
But it wasn't. Now there's weekly options.
Which makes earnings plays a lot more enhanced to it. Sure.
Yeah, it's a short-term play. It's a premium
should
play.
be overnight.
Well, it's a premium play. It's a 1, 2, 3 day, whatever it is. Because most companies, there's not a lot of Monday morning. There's not a lot of Friday earnings.
Right.
Because
Friday before expiration, you say no expiration.
There's not a lot of Friday afternoon earnings because companies just don't report Friday afternoon.
Oh, yeah.
For lots of different reasons. Because if
They don't want it to be closed for 2 days.
well, the assumption is too. You don't want you want. You're going to have something good happen. You want to get that into the marketplace right away. So companies don't report Friday afternoon, and very few companies report Monday morning. So generally, you're talking Tuesday, Wednesday, Thursday, and you have expiration on Friday. That's a good thing.
Absolutely, it's beautiful.
So we got weekly options now, which means, and we have weekly options. We have electronic marketplaces. We have tons of liquidity and tons of capital seeking different strategic plays.
Yes.
Whole change in dynamics with respect to the way people play derivatives. So let's talk about some of the keys for expiration plays. Okay?
Well, yeah, absolutely.
What do you got?
First of all, liquidity is king always. Not only do you want a liquid underlying, but you want a liquid options market attached to that underlying.
So liquid underlying, liquid option market, that's complete common sense.
Yes.
All right, what else?
It's a must. Weekly options are preferred.
weekly options, especially if you're in an expiration week, it doesn't really matter. But if you're not in expiration week, weekly options, because an earnings play is just that. It's an earnings play.
Yes.
It fits the equation.
It's
a
not a
short-term
duration.
trade.
It's not a durational play. Everything we do on the show is about duration, extending duration, except for earning plays.
Except for
earning
earnings.
plays are not. They're not a duration play.
Right.
Okay.
Yeah, you want to use implied volatility increase. Obviously, you want to get as much implied volatility on the front month or weekly option as you can.
We call it the term that we use on the show, and you're 100% right. The term we use though is vol differential.
Vol differential. Yeah, you want. I prefer 2 times or greater implied volatility on the front month versus whatever the following, whether it's another weekly or whether it's the original.
Well, it's whatever it is. But Tony and I both agree with you that it needs to be a significant enough vol differential between the weekly option and the normal, the standardized option, the standard expiration, to give you at least the idea that there is something there to do.
That there's a lot of juice, a lot of fat.
There's something there to do. Yeah.
Absolutely.
So you want a pump in front month volatility. You want a huge increase in front month volatility.
But you're not getting any edge there.
There's no edge.
It's there because
It's there for a reason.
It's there
for
for
sure.
a reason.
But it gives you a little bit of opportunity to get creative and get a little bit further out of the money, or at least be at that out of the money.
Gives you a
spread.
reason.
Makes it interesting.
Makes it interesting. What else you got? So we have liquidity. Something you mentioned earlier was easy to borrow, hard to borrow.
Easy to borrow, hard to borrow. I tend to avoid anything that's hard to borrow. If the underlying is hard to borrow, if the underlying is hard to borrow, the stock is hard to borrow, then that's kind of goes along the liquidity
and most
lines.
trading platforms will have that right on their trade page.
Look at the top right, HTB. If it says HTB,
you can have situations where the stock is actually where it's plenty liquid enough, but hard to borrow stocks do impact the pricing, the efficiency of the pricing of the options.
Right.
So you're right. Liquidity is one thing, but then the efficiency of the option pricing based on easy to borrow, hard to borrow, very important.
Yeah, I don't want an underlying that's directionally limited.
That's right.
As far as my trading ability for it.
Okay. What else is there?
Expected move. You need to know the expected move. That's very key. And I personally prefer strategies that stay outside of the expected move range. So say you got a $100 stock and the options market is pricing an expected move of 5 points. That means downside is 95, upside is 105. I prefer a strategy that, say, an iron condor or a short strangle that has break evens at 95 and 105 or greater. Preferably greater.
Makes sense.
Yeah. I mean, in a perfect world, we like 2 times.
Yeah, I love 2 times, but you have to have some nice fat implied volatility.
Let's do 3 times and get enough premium.
Yeah. No. I understand, but it just depends on the underlying whatever it is. But we're in agreement. So those are all key pieces. What else you got?
That's pretty much it.
I'm only going to add one more thing, which is price. So the other piece to the earnings play, which I think is very important for individual investors, is the price of the underlying or the capital requirement to make the trade. So there are different strategies that have, obviously different capital requirements based on either stock price or based on the strategy selection. So for me, one of the elements of earnings trades are making sure that you are positioned right capital-wise. In other words, you don't want to do something that you don't want to do a trade that you don't really like because you don't have the capital to do what you like.
Say that again.
Let's say you want to make a trade. There's a trade you really want to make, but you don't have the capital to make the trade.
Okay.
So you do something else.
Oh, a different strategy.
A different
strategy.
Right.
No, absolutely not.
So for certain people, there are certain stocks based on the strategy that you can't do. So, for example, you like selling strangles, let's just say. It's very different to sell a strangle on a $25 or $50 stock than it is to sell on Google
$600
at $650.
Right.
Okay, because you're selling, your capital requirement is 20% of the price of the underlying, and it makes a big difference if one underlying is 10 or 20 times the price of another one. And sometimes a certain strategy doesn't make any sense.
Correct.
So in other words, so you have to make sure that you have the capital that's appropriate or the buying power reduction available that's appropriate to the strategy you want to do for the earnings play.
That's very important.
Now, there's another thing about earnings too, is that because they're short-term plays, they free up the cash.
Yeah. Yeah, that's nice.
I mean, the following day, the cash gets freed up.
They're short-term
nice
plays.
Overnight quick play. I mean, you shouldn't get overexposed in the play either, as far as your position sizing. Now, another thing that I do is I have specific criteria for specific strategies. So, for example, if it's a short strangle, then I want to be at least 1.5 times outside of the money range, outside of the expected move range. And if it's an iron condor, I can deal with being right at around the money. You know what I mean? So preferably 2 times, but I'll take 1.5 times on a short strangle, and I accept 1 times, but I prefer 1.5 times on a defined risk spread like an iron condor if I'm doing outside the expected move strategy.
Okay.
And I'll enhance short strangles with maybe a butterfly at a specific price point. If I have a bullish bias, then I'll do a butterfly on the upper end of the the upper leg
Sure.
of the short strangle.
Sure.
So it's just fun to be creative with these spreads, and the increased implied volatility gives you opportunities to get creative and have fun with the earnings plays and put yourself in a high probability position of success. So,
well, Tony and I will all the time. We'll do things like we'll sell an out of the money strangle at 2 times or close to 2 times the expected move, and then we'll
In the right stock. We don't do it in all.
no, not in every stock, and then we'll take a portion of the credit we receive, and we'll use that credit to buy some kind of wide butterfly up at the upper end of the range to give us some additional kicker, so that if we get, because there's a lot
In
of
the
time,
direction that
exactly,
we really,
that's exactly what I was.
really feel
but we usually pick one of the 2 directions.
Right.
So it's a double whammy when it goes the other way, past your strike.
It's a double whammy when it goes your way, though. I mean, it's a quadruple whammy.
Well, it
good.
could be.
Right.
It could be.
Right.
It could be. It doesn't. It's all a crapshoot. But something I want to get back to, Nick, which we didn't spend a lot of time on, is the nice thing about earnings plays is, again, that because the expectation is so different than a normal directional play, that or than a normal assumption, a normal strategic play, that your capital frees up so fast that it's money that gets continually put back to use.
Yeah, absolutely.
Okay, so it's a little bit of a different mentality than like, for example, yesterday we did a covered call. I'm sorry, yesterday we did a call spread. The day before we did a covered call. Both of those positions were designed for a 30-day period
To benefit over time.
That's right.
Right.
And one thing that's important that we talked a lot about weekly options, but it's not mandatory to have a weekly option, because not every stock that meets the liquidity criteria and the easy to borrow and has inflated implied volatility on front month versus back month.
But then you might look.
They don't always have weekly options.
But you might look
not
at
everything.
different strategies then.
Yeah.
If you don't have the weekly option.
I just
right?
want to make sure everybody that's
Sure.
listening knows that it's not mandatory that you have a weekly option offering in that specific underlying, that you can still do an earnings trade on a stock that doesn't offer weekly options.
Yeah, so I think right now, what's the stat? 82%.
Yeah, there's a ton.
No, but 82% of all the volume is done in underlyings that have weekly options, something like that. It's a ridiculously high number. So you don't run into too many situations where depending
I think
whatever.
Starbucks, if I remember correctly, last earnings season I did a calendar. I don't think they had weekly options.
They might not have.
I don't think they do.
It doesn't matter. There's nothing to do in Starbucks. Just buy it.
Yeah, that's true.
He's
buy
being
it.
facetious. Don't
Just buy
listen
it.
to him.
Yeah, we had some fun yesterday. We were interviewing some people, and I said they're not really, they're not really traders. They're outsiders. Just starting to get involved in the industry. And I was like, hey, if you could buy any stock, what would you buy? Okay, of course the answer is
She named 2.
Is Apple?
Apple was the first one,
Yeah.
and then Starbucks.
Yeah.
Apple, Starbucks. But every person says the same thing.
Yeah.
Hey, if you could buy 2
His
companies,
head spun around.
I'm like, if you could buy 2 companies right now, Apple and Starbucks, and when you look at the market, you're thinking, you know what? That's why Apple and Starbucks go up every day, because everybody thinks the same thing.
Do you guys watch coffee futures at all?
Coffee futures?
Yeah.
Not really. Yeah.
Coffee futures look like they may be bottoming here. Coffee and sugar. Just a side note on the Starbucks conversation.
No.
Where's sugar trading right now?
Sugar, I can't remember the exact price point. I know it's at a nice level of support though.
I haven't. Last time I traded sugar, it was 13 cents.
Yeah,
13 or 12 cents. I haven't. I every couple of years, I get involved in sugar and coffee. Always when they're on the lows, and I'm always just a little bit early.
But
usually when they gotten killed.
You know what's an interesting reward to risk opportunity that
Is
you
this
guys might like?
Is it SB? I mean, is that
SB
sugar?
is sugar.
Yeah.
I might cocoa and sugar and coffee, all 3. But soybeans,
This is
ZS,
sugar.
ZS. Yeah, so you get some decent support there, decent risk reward.
Mhm.
ZS soybeans, just to kind of throw a nice a risk reward opportunity out there. Soybean short looks like a really nice opportunity here, because we had a really strong inverse head and shoulders pattern. It
I'll take a
measured,
look at soybeans,
it
yeah.
measured, yeah, it measured like 140 points. It broke off of this. I think it was like measured to 13.
Okay, I don't know what. I mean, I don't trade soybeans. I mean, I know what they are, and I used to have a seat on the board of trade. But if I had to put a gun to my head here, I don't know if it's a head and shoulders or anything else like that. But I want to get shorted too.
Yeah, do you see the inverse head and shoulders down there at the bottom?
You're
It measured about
talking
100. Measured about 140 points up to 1380. So you see when an initial parabolic move up to 1380 after it broke the inverse head
You're talking
and
about this
shoulders
kind of thing?
neckline. Yeah, and then
Soybeans are
it had an
$14.
initial drop off, then spazzed out against the upside. Now we're at that 1 year resistance level. So we've completed the measured move of the inverse head and shoulders, gone beyond it, and now we're at a really strong previous level of resistance. I mean, I think it's a really good risk reward opportunity there in soybeans.
14. You know what?
Problem is, it's just not liquid enough.
It's not liquid.
You just got to trade
I just wanted to tell him because
the option. Sure.
I know he likes.
When I was an early
it's not
young
talked
trader,
about very often.
young buck, Tony, I had a bug up my butt. I wanted to buy soybeans so bad. They were trading for right around $4, and I'm like, $4 is ridiculous.
Right.
The world's going to eat soybeans forever. This is probably mid 80s or whatever, early 90s. I don't remember what it was. They're trading just over $4. I was selling the 4 puts and collecting like 25 cents, and I was like, that's a stupid trade because the things are going to a gazillion.
Right.
I think
you only have a limited amount of money if you're just
right.
selling the put.
And I'm thinking, but I couldn't get filled. So I actually hired a trader, put him in the soybean pit, and didn't realize how much money that was going to cost me. And
should have just paid up.
Should have just paid up to do whatever I wanted to do. But I wanted to buy like these long-term call spreads. So I'd be buying like the 4-5, the 4-6 call spreads, going out like a year in time because I figured soybeans have to go back to, whatever, $8, $10. We used to have this thing about beans in the teens. Beans in the teens now. Now beans are in the teens. And all I wanted to do is
time and duration, Tom. It only took you to become an old
20 years.
fart.
20 years. If I'd waited 20
it finally
years.
worked. He was just really early.
It's typical.
20 years early. But that's why when people look at natural gas right now, that's why I feel that the same way.
Right.
All these times throughout my trading career, when I remember commodities getting down to, it's different. I mean, soybeans are still, well, not soybeans, but sugar is still 22. I've traded sugar down to 12. So, there are definitely, it's got room if it wanted to, there's more room.
Sure.
But when you start talking about things at $1.80, not that much more room unless you shut it down.
Especially in a commodity world.
Yeah,
Different animal.
Oil
world.
at $9, you're thinking, okay, because I remember having this conversation with lots of oil traders. They're like, well, it's $9, but it's going, it looks like it's going to 6.
6, right.
But I'm thinking to myself, because I'm not an oil trader.
Right.
So all I can think to myself is, okay, let's just say it goes to 6.
It ain't going to 0.
Yeah,
Right, it's not going to 0.
Right.
Oil's never going to, even though they kept saying, well, it could go to close to 0. But
solar
risk
power.
3 to make 11, or
But yeah, you risk 3 to make 11.
Yeah.
Exactly.
Makes a lot of sense.
Exactly. And you're talking about, people don't recognize what the implied volatility is essentially telling you. I mean, you can go, let's a simple example. Let's pull it up, Tone. We can pull up natural gas for a second.
Where is that right now? 202?
Yeah, right around there. I don't know. Hang on, I'll pull
Not
it
allowed
up.
to mention it.
That's crazy. Full disclosure, I lost my ass on some UNG positions, but I'm completely out. It feels great. I wrote an article about sometimes taking a loss is a win.
So
get rid of
natural
it.
gas is trading for $2.02. But here's let's talk about the interesting thing. Pull up a natural gas chart, because this is what I think most people don't understand. It has an implied volatility of 50%. Implied volatility of 50%. We're talking about a $2 instrument with an implied volatility of 50%. Now, this is not, assume we can't go out of business. Assume it can't go to 0.
No.
Well,
Okay,
I've read articles where it says it's going to go below 0, but okay.
How does it go below 0?
I don't know, but that's what I was reading. I'm just telling you what I read.
I don't care what that says.
That's what the kind of crap that's out there.
Are you serious?
Yeah.
Oh, I thought you were joking.
No.
So,
Wow,
so here you have a $2 instrument with a 50% implied volatility. Now, we all know what 50% means, implied volatility. That means over the course of the next year, whatever it is, it's going to $1 or $3. That's it. That's where it's trading.
50% moving a year.
That's a two-sided market on a, it's not that liquid and underlying. There's only 31,000 contracts have traded today. But
actually twice as much as sugar and
soybeans.
But
soybeans that we were looking at.
Yeah.
But you've got 50% implied volatility on a $2 commodity. That means $1 or $3. Now, let's be realistic about this.
I don't care what it is. I'm taking $3 to $1, not because I'm a raging bull on anything. It's a commodity for crying out loud.
Exactly.
Gun to your head.
Right.
Gun to your head. Okay. Are you picking
picking $3? I'm not picking 1.
Okay. And then if you're thinking about your
so stock, it would be a different story. It'd be
of course. If it was General Motors, I'd be saying, okay, go to 0. I understand that, but it's not.
Right.
So now you're thinking it's trading for $2. Is the real downside $1.80, $1.50? Let's just say it's $1.50.
Okay.
If the real downside in there is $1.50, and the upside is a fact because you can trade it, it's $3. That's what the marketplace is saying it's going to get to. $1, $3.
You like that pot?
You have to like those odds.
Right.
That's 2-to-1 payout. That's
no.
it. There's nothing else to it. There's nothing else to it. There's nothing. That's the business.
It's very basic, yeah.
So, and why is it there? Because
Fracking.
That's the odds. That's it. You get paid 2-to-1 to buy it at the low with high volatility. I don't know. That's all.
It just depends on whether or not you can take the pain.
Yeah.
I think it's going to bring a little more pain.
How much pain can it bring? Is it going to
50
$1?
cents.
50 cents. Whatever. Okay.
Yeah.
But okay.
It's a big contract.
Yeah, it's a
Those
big
who are
contract.
playing it, so be careful.
It's a big boy.
It's a big boy.
Sounds
That's
it's
what I mean.
$2.
I mean,
this is not like, buying VIX or VXX or something like that at $8. This is a big boy contract.
So Nick, there's no real earnings place today, but tomorrow we have Google.
Google.
So you all fired up for Google?
I haven't looked at it very closely. I didn't trade Google last earnings season, but I'll definitely take a look. I mean, I love looking at all the different opportunities.
We do Google every time. Can't resist Google.
Last earnings season, I did LinkedIn, Open, Apple, CRM. I mean, I was 8 for 8. I did 8. I was 8 for 8.
That's nice.
I posted them all publicly, so I'm not just BS.
Whatever. Whatever.
No, it's good.
Yeah.
Earnings season last year, everything came inside the expected
It's true.
range, and if you were doing the things that you were talking about earlier, then it should have worked well.
Last earnings season was
It was actually a really nice earnings season for the strategy that
It was a moneymaker, yeah.
Yeah.
This-
Google's setting up though.
which scares the living crap
Yeah,
out
I
of me
know.
for this one.
Yes, it does.
Exactly.
Google's setting up for you though. Of all the things that you were talking about, highly liquid in the stock, easy to borrow. Great derivatives market, large expected move around 40 points. I'm just eyeballing it here. Almost a 2 times vol differential. So I think maybe you'll have your first play in Google this time. We don't know, but we'll see.
I agree. I say there's a very high chance.
Nick Fenton from TickerTank. And
Yes.
thanks, Nick, for coming on in today, man. Good stuff as always to see you. We're going to take a very short break and come on back with good trade, bad trade.
If you're not a member at this time, take these few minutes, about 20, to look to the right hand side of your page there and click on our special offer where we have a book deal for you. We will be back in 20 minutes. 855-238-2789, where we do a call in with Tom and Tony. Want to add anything?
Be sure to check out the Superstore because there's a lot of great stuff in the Superstore.
I'm all good, man.
All right, we'll be back in 3 minutes.